Rishi Jain and I have completed all levels of CFA and am a chartered accountant. I hope you all know about the CFA course, and if you do not, we have uploaded a special webinar just to tell you about the CFA curriculum and how the subjects are distributed in the CFA course. Pankaj sir will be taking 2 classes per week and I will be taking 3 classes per week, and that is how we have distributed our classes. And we are going through a whole journey of CFA, and I hope that you have a lot of fun while learning everything about finance. So before moving forward, let us see that what are the subjects that are there in CFA. Even the CFA curriculum, this is as per the CFA website. So even the CFA website puts the most emphasis on ethics and professional standards, which can be given as high as 20% weightage in your examinations. Then comes quantitative methods, which you started yesterday with Pankaj sir. So now there is one important thing which I would like you to know, that quantitative methods, even though it says that it only has 8 to 12%, but the concepts of quantitative methods are there in every subject. For example, even portfolio management, equity, fixed income, derivatives, all these subjects will have some levels of quantitative methods included in them, and you will have to use the concepts learned in quantitative methods in every single topic. So be sure that you are thorough with every single topic, and if you have any queries, feel free to contact us. We will be sharing your numbers so that if you have any queries, you can contact us at any time. Today we will be starting with financial statement analysis. Now this is among the subjects which do not require any concepts of quantitative methods. That's why we have decided to pick that up. Okay. So we will be starting in 1 minute. Okay, so let us start. The first class of financial statement analysis, or LOS 16. As per the CFA curriculum, every person who is going to do LOS 16 should be able to do the following. This data is as per the CFA curriculum and you do not need to memorize these. This is just for an understanding of what you are supposed to understand after you have completed this chapter. This is just a basic and introductory chapter and there's not much information here. So let's get started. First, let us understand what is the difference between financial reporting and financial statement analysis. As per the definition, financial reporting is the duty of the company and the accountants of the company, and it includes the statement of financial position, the statement of financial performance, and it includes the changes in financial position. So what are those? The statement of financial performance is nothing but the profit and loss account, or the income statement as we commonly know. So it says how much revenue the company earned during the year, what were the profits that the company earned during the year, and what were the expenses that were incurred to earn those revenues. So profit and loss statement, I am pretty sure that everybody must have heard about it. So that is the statement of financial performance. Next, we come to statement of financial position. The statement of financial position is nothing but the balance sheet of the company. It says what are the assets, liabilities, and the owner's equity as on a particular date. So at the end of every reporting year, which might be 31st December, 31st March, depending on which country you are in, on that date you have to tell the statement of financial position. Every company is required to report it as per law. So that will be the statement of financial position and the changes therein. The financial reporting also covers interim financial reports which the companies are required to submit on a quarterly basis. So for example, if a listed company, let's say your favorite Facebook as a company is called Meta. So Meta Incorporative is required to submit their quarterly reports to the SEC, which is the regulatory authority of the United States. and they're required to submit their accounts and their statement of financial performance, their statement of financial position every quarter. So all these become a part of financial reporting, which is required to be done by the company itself. And then what is financial statement analysis, you might ask? That is something which is done by analysts and portfolio managers, investors. So for example, as an investor, I want to invest in a company. As our example goes on, Meta. So if I want to invest my money into Meta, I will first want to know what kind of business Meta is running, whether it is running a profit, and whether or not I will be able to earn a profit by investing my money into Meta. So for that, I will need to analyze every single financial report that they submit. So that the analysis of the financial statements is known as financial statement analysis. So as per definition, let's read what it says. Financial statement analysis: a company's financial reports and other related piece of information which are submitted by the company, which includes the financial notes, supplementary schedules, and other information. We consider every information that is submitted by the company and then come to a conclusion of whether or not it is viable for us to invest in the company and earn a profit. So this is just an example, and financial statement analysis might be done by a number of different kind of stakeholders. It might be done by the creditors of the company to understand whether or not they will be able to receive their money back. It might be done by the government to understand how the country is running. But financial statement analysis as a whole means analyzing the financial reports and other information which is submitted by the company. Moving on. Now let us understand what are the components of financial statements. So as we heard earlier, financial statements include a statement of financial performance, a statement of financial position. It includes statement of changes in equity and a statement of cash flows. Let us understand all of these one by one. Coming first, let us understand the statement of financial position. The statement of financial position, as I said earlier, is also commonly referred to as the balance sheet of the company. It includes the assets, liabilities, and the owner's equity. Now, what are assets, liabilities, and owner's equity? If you're a commerce student, I'm pretty sure you're well versed with it. And since we are all doing a professional course in finance, these are basic terminologies which I expect you all to know. So assets are basically the resources that a company owns. For example, for a manufacturing company, it might be the machinery and the plants, the factory of the company. All these are assets for the company. Next, liabilities. Liabilities are the amounts which are owed to lenders and other people. For example, if I purchased my raw materials or I purchased a machinery on credit and I did not make the payment as and when it was purchased, then the amount that I will have to pay to the lender, to the vendor at a future date of time, that is known as a liability. And last but not the least is owner's equity. While opening a company or any business, every person requires to invest a little bit of their own money, which changes over time with the profits and losses that the company accrues. Now this portion is known as the owner's equity. It is also referred to as the excess of assets over the liabilities of the company. So basically, assets minus liabilities equal to owner's equity. So here you can see that it's written assets equal to liabilities plus owner's equity. Using simple algebra, we can do assets minus liability equals to owner's equity. Or alternatively, we can also write liabilities equals to assets minus owner's equity. So this is basically simple algebra, but I hope that you all get a gist of what a balance sheet is. Next, moving on to the statement of comprehensive income. Now I guess I already mentioned that it is also known as the statement of financial performance. Now what is the statement of comprehensive income? Now the statement of financial performance is also referred to as the profit and loss account, which finally gives us the net income of the company. So net income equals to revenue, oh my god, revenue minus expenses equals to net profit. So this is something which I guess everybody will know. Revenue minus expense give us net income for the company or net profit for the company. But there is a separate component called other comprehensive income. This is something that we will be learning at a later point in time. We will be discussing other comprehensive income at a later stage in a future class. So for now, let us just understand that net income plus and minus the adjustments for other comprehensive income gives us the total comprehensive income of the company. And this statement which presents the revenue, the expenditure, the profits, the other comprehensive income, a whole statement is referred to as the statement of comprehensive income for the company. Next, let us see what is the statement of changes in equity. Now I already told you that the statement of the owner's equity is the excess of assets over the liability of the company. Initially when we start a company, the owner's equity is is already known to us, but as the company moves forward, the company earns profit or it incurs losses. Those are all adjusted with the owner's equity. There are several other adjustments also which might take place, which you will be learning in the later stage of time. But a statement containing the changes in owner's equity is referred to as the statement of changes in equity. It is also known as the statement of changes in owner's equity or statement of changes in shareholders' equity. Its main components are the paid in capital. Paid in capital is the amount that was initially paid when the company was started. So for example, I am the founder of the company and I started a company with a $1 million. So that $1 million that was the initial paid in capital is referred to as that. Retained earnings are the cumulative profits of the company. So for example, in 2022, the company earns a profit of 1 million. In 23, the company earns a profit of 3 million. And in 24, the company incurs a loss of 1.5 million. So 1 plus 3 minus 1.5 gives us 2.5. So at that point of time, the retained earnings of the company will be 2.5 million. And reserves are other amount of money which depends on the accounting standards. It might be capital reserve, an amount which is earned on rare. For example, gains on sale of asset might be transferred to capital reserve. There might be general reserve, share premium account, and several different types of reserves which you will be learning later. Next comes the statement of cash flow. So when we heard about the statement of financial performance or the statement of total comprehensive income, that gives us a money earns on accrual basis. So let us understand what is come to me at. My sale has taken place, but the money is still with him, and I will be recording Mr. X's name as a debtor in my books. And let us say that I purchased the machinery from Mr. Y for another sum of money, again on credit. I did not pay any sum of money from Mr. Y, neither did I receive any sum of money from Mr. X, but I bought a machine and I sold a machine. So two transactions were completed without any money exchanging hands. So in that case, what will be affected? Will the statement of financial performance be affected or the statement of cash flows be affected? This is a very simple answer, I guess, in this case. So the statement of financial performance will definitely be affected in this case because we are making our books of accounts on the accrual principle. So we will be recording the revenues and expenses whether or not money is exchanging hands. But what if as an investor, I want to know what is the actual transfer of money that is taking place in the company? That is when I will be looking for the statement of cash flows. The statement of cash flows records only if cash is exchanging hands. It is divided into three components. Number one, operating, investing, and financing. These are the three portions, three divisions of the cash flow statement. So what do these refer to? Number one, So operating cash flow, the operating segment of cash flow statement refers to the money that is incurred or expensed while running the operations of the company. For a, let's say, for a trading company, it might involve the operating cash flows involves the entire money that comes and goes while buying the goods and selling of the goods that the company deals in. So every transactions in relation to the operations of the company, even if the payment, if I want to pay to my employees, that is something that I'm doing for the operations of the company. So that will be coming under the operating cash flow segment. So if everything is covered into operating cash flows, then what does investing and financing cash flow segment take even exist for? So for investing, let us say that I have some extra money. I am a trading company, but I have some extra money in my hands. In that case, what I can do is I can invest my extra money temporarily into stocks, into fixed deposit, or into any other form. For example, even if I want to buy a new money machinery for my company, that is something that is investing. I am investing my money to gain returns at a future date of time. So that is known as a investing activity. Excuse me. So that is known as an investing activity. So for investing activities, those are recorded in the investing portion of the cash flow statement. And finally, coming to the financing portion of the cash flow statement, financing refers to the raising of finances and repaying of your debts. Let us say for running my company, I need to borrow $1 million. So that borrowing is something that is a financing activity. Or let us say I am going to repay my borrowers, repay to the person I am borrowing from, or I am going to raise additional money through issue of equity shares. Any of those activities are financing in nature, and those will be recorded in the financing portion of the cash flow statement. So this basically covers the entire statement of cash flows that should be relevant for exam purposes. You are required to understand just every single four things that I mentioned, and you should be able to name them, and you should be able to tell what are the components and which items goes into which. For example, if I say that customer X is my debtor, so as a debtor, in which statement should it go? Should it go into the statement of financial performance, financial position, or cash flows? This can be a question in your exam. So what will be your answer? Good. So your answer is going to be the statement of financial position, because a debtor is an asset, and assets and liabilities are components of the statement of financial position. So this is how the exam questions can be framed. Okay, so before moving forward, let me tell you something about the question structure of CFA level 1 exams. Now level 1 exams will be MCQ based, that is multiple choice questions, and make sure you remember that there are no negative marking. So you have to attempt every single answer. Remember that. You do not leave any answer. Complete the entire question paper. And now, since this is going to be MCQ, do not think that it is going to be very simple. CFA is very practical in its approach, and instead of getting a simple question like I just mentioned that Mr. X is a debtor, you are not going to get such questions. The questions will be very detailed. You will be given a long paragraph explaining a situation. So for example, it might say that XYZ is a company involved in the process of manufacturing good Y, in which they were involved. Basically they will be giving a whole lot of long story, and after the story is complete, then you will be asked questions relating to that particular story. Now the questions will be similar to what I mentioned, but you need to make sure that you understand the whole paragraph that is given to you before starting to attempt questions. So I will be keep mentioning small tips and tricks about CFA as we move forward. Let's move forward. Next comes footnotes, audit and analysis. Okay, so apart from the statement of financial position, financial performance, cash flows, What else is the company required by law? Legally, they are required to mention notes to accounts or financial statement notes and management commentary if you are a listed company. These are some things that are compulsorily required. Financial statement notes are required for every single companies, while management commentary might be required only for listed company. Again, it depends on the country and the specific laws to which country you belong in. Financial statement notes. So let us say I give you a statement of financial position and I tell you to interpret it. You might be able to do it or you might not. However, there are certain information which you need to understand before moving forward. Every item of the balance sheet and profit and loss account can be interpreted in a multitude of ways. Let us take a very common example, inventory. Inventory is the goods that I deal in, and I might record the inventory at cost price, at market value, or present value. That is completely my choice, and nothing will be wrong. If I record my inventory at market value, is that wrong? Or should I record it at the price or cost which I paid to buy it? That is a very relevant question, and both might be allowed, neither might be allowed. To understand which policy the company is following, we need to understand the company's accounting policies and accounting estimates. Now, these accounting policies are mentioned in the financial statement notes, and every company is mandatorily required to mention what accounting policies they are following, what accounting estimates they are following, and if they have changed any accounting policies with respect to the previous financial year. For example, in 2021 I was following one accounting policy and I was recording my inventory at market value, but now I have a change of heart and I want to record it at cost. Can I do it? Again, it is not that simple. It depends from country to country, and there are certain laws which prevent us to changing the accounting policies with the whim of my mind. I need to have a reason to change it, and I have to give a lot of disclosures in our financial notes so that the users of financial statements are able to interpret and understand why the change took place. So let us read. Notes to the financial statements provide important disclosures such as the basis of preparation, the reporting currency, the accounting policies, and other important information. The reporting currency, if you are living in United States, might be the US dollar. If you are living in India, it might be the Indian rupee. So that is something that needs to be mentioned, so that if a person living in some different country is going to read your accounts and try to understand it, they do not have any issue in determining what kind of currency that you are using. You have to also mention the accounting methods, estimates, and assumptions. Everything needs to be detailed clearly in the financial statement notes. They contain significant information regarding acquisitions, disposals, commitments, and contingencies, legal proceedings, employee stock options, other benefits, related party transactions. So these are some things that you need to keep in mind. These are certain questions that can come in your CFA level 1 examinations. They can ask, a company is going through legal proceedings and they have certain issues that are pending with the income tax department or the IRS if you are living in America. So where do the company need to disclose such information? And your answer is going to be that such information is required to be disclosed in the financial statement notes or the notes to accounts to the financial statements of the company. This is extremely important, and I hope that you all remember this. Moving on to management commentary. A management commentary or management discussion and analysis, it contains certain additional information about the company's performance. For example, let us think of a company which is app based. Everybody's favorite, Facebook or Instagram. Those companies record their users per day and users per month. Those are certain information which the users of financial statements might find relevant. For example, if I want to value a company such as Facebook, I will not be able to determine its value without knowing how many people are using Facebook, because its value is based on the number of people using it. So the information about average daily users and average monthly users and any further such information is mentioned in the management commentary or management discussion and analysis. It is included as a part of a public company's annual reports. It provides an assessment of the data reported in the financial statements and is very helpful for completing our financial statement analysis. Now, before moving forward, let me give you an example of an actual annual report. I have downloaded the annual report of Meta, everybody's favorite, Facebook. Let us take a look at the annual report of Meta. See, if you look at it, where's see, it will be very long. How many pages? The entire annual report is hundreds of pages for big companies. Can you see? (116 pages for Meta. Now let us see whether every single thing which we mentioned right now is available in the annual report of Meta. Let's start with balance sheet. Okay. Balance. Oh my God. Balance sheet. It is here. So this is the balance sheet of Meta. Can you see? They have reported in millions. So the total asset of Meta is $165,987 million. It is not dollars only. It is $1,000,000 for assets and liabilities. This is Meta's statement of financial position. Next, coming to Meta statement of financial performance. This is the consolidated statement of income or the statement of financial performance or the statement of comprehensive income for Meta. See, the net income, other comprehensive income and total comprehensive income. As I mentioned, so every data is available in the statement in the annual report of the company. This is the statement of changes in shareholders equity. Can you see? So it presents as on 2018 what was the value of the shares, what were the changes during the year, and what is the closing balance for this financial year. Next, coming to the statement of cash flows. Now you will see that how the total cash flows is 16,865 million, but the profits might be very different. So even though the total comprehensive income is 37,000 million, yet the cash flows is much lower. The total cash flow is only 16,000. Can you see? So there's a major discrepancy between the actual total comprehensive income that Meta is presenting and the total cash that Meta is actually earning during the year. So we need to understand there's a major difference between the two, and it is only because every company is following accrual principle. Now after all three, what comes next? Let's move on to the notes to accounts. See, these refer to the notes to consolidated statement and contain the significant accounting policies that are followed by the company. Estimates. We will be learning everything. Revenue recognition is something that you will be learning the very next day. We will be learning how revenue recognition principle works. It's advertisement revenue, reality labs revenue, how Meta records every single revenue. These are the notes to accounts. And as a student of CFA, I highly recommend that you should start reading annual reports. If you have any queries, you can call me, but start reading annual reports and they will help you get a much better understanding of the curriculum. Next, let us see management discussion. They might use some different here. This is the management discussion and analysis portion of the annual report. See, as I mentioned, these discuss different income as per, this is the app revenue for Meta, and Meta has a lab segment in their company which you might not know of. So the reality lab portion, this the amount of revenue that is earned by the lab and the total. So they have divided their revenue in different streams of business. This is also something that might be relevant for the investors and other stakeholders of the company. Next, as I mentioned, a very important aspect of app based companies is daily active people. So that this is the daily active users and the monthly active users. How many people are using their app on a day to day basis? This is very relevant information, and such information are present in the management discussion and analysis segment of the annual report of a company. I hope you understand what every component of financial statement is and how every single component is relevant. Let's move on. Audit. Chartered accountants and CPAs and public accountants. This is the portion for you. So independent review. What is audit? An independent review of the entity's financial statement. What does this mean? So a company presents the financial statements and gives it to you. How do you know that it is correct? Do you know that it contains any material misstatements? You might not get the correct true picture of a company if there are any material discrepancies in the financial statement that have been presented to you. How do you verify it? Through audit. So every company is required to conduct an independent review through auditors. You might have heard of the big four company, Deloitte, KPMG, EY and PwC. Though these are audit firms. They do an independent review of companies and tell us whether the financial statements are without any material discrepancies and whether or not we can rely on the truthfulness of the financial statements. See, independent review of the entity's financial statement conducted by public accountants. You need to remember this portion. And the standard audit opinion contains of three parts. Any standard audit opinion contains of three parts. First, that the financial statements are prepared by the management. The auditors are not preparing the financial statement. It is prepared by the management of the company, and its responsibility lies on the management. The auditor is only responsible for conducting an independent review of the financial statements that have been prepared by the management. So prepared by management, review conducted by public accountants and auditors. The auditor gives a reasonable, not absolute assurance that the financial statements are free from any material misstatements and the generally accepted auditing standards were followed in conduct of the audit. One thing we need to understand is that an auditor can never give an absolute assurance that the financial statements are free from any sort of misstatement. The assurance that is given by the auditor is always reasonable. So there's a reasonable assurance that the auditor provides that the financial statements are free from any sort of material misstatement. Now the auditor is satisfied that the statements were prepared in accordance with the accepted accounting principle and the principles and estimates that were chosen were reasonable for the company. What does this section mean? This section means that the company is choosing a accounting principle which is correct for it, which is reasonably correct for it. So for example, a company cannot, let us say a construction company. A construction company will be construction one building over a period of, let's say, 1.5 or 2 years. So they cannot recognize the revenue entirely on day one. Even if, let's say, Mr. X is my is the person who's buying the building from me. So he's going to buy a building and he pays me the entire money on day one. But I will be giving the building to him ready after 2 years. So can I recognize the entire revenue on day one when he gave me the money? No. I will only recognize it as and when my performance obligations are being fulfilled. We will learn about this on a later date, but this is an accounting principle which the company needs to follow. So for a construction company, they need to make sure that they're recognizing the revenues slowly as and when their performance obligations are getting fulfilled. So this is an accounting principle, and the auditors need to make sure that the correct accounting principles and estimates are being used by the company. So we need to remember these three aspects of audit: prepared by the management, review by the auditor. Number two, reasonable assurance that they are free from material misstatement, not absolute. Reasonable assurance that they are free from any material misstatement. And finally, that the generally accepted accounting principles and estimates that have been chosen by the management of the company are reasonable. So these three aspects needs to be remembered by you. Okay, this page has been repeated, but there's one important note. So internal control refers to making sure that the company's operations are going are happening in a proper way and there are no frauds or any sort of discrepancies that are taking place in the day-to-day functioning of the company. And internal control, which makes sure that that happens, is the responsibility of the auditors of the company. Now let us see. So when we read an auditor's opinion or the audit report, what are we looking for in a company? What is ideal for a company? An unqualified report. An unqualified report means that the auditor is saying there is no issues. The company is free from any material misstatement and the generally accepted accounting principles or GAAP were followed by the company in preparing their financial statements. So if we see an unqualified report, that is something that we will be looking for and it is ideal for any company. So again, coming back to our friend Meta, audit report. Let us see whether their audit report is unqualified or not. What do you think? This is the report of independent registered public accountant and this is the opinion. We have audited the accompanying consolidated balance sheet of Meta. The related to this. So it is in conformity with the generally accepted accounting principles and it is free from any material misstatement. So they mentioned an unqualified opinion. See, so they have issued an unqualified opinion because as per the public accountants, the company does not have any material misstatement in the financial statement and the company is in general following the generally accepted accounting principles. Now, if we are not getting an unqualified report opinion, there are three other opinions that might be issued. The three as a whole are referred to as modified opinion. See, all three are known as modified. So if it is not unqualified, what is one thing we know? It is definitely a modified opinion. All three collectively are known modified opinion. Now, there are three kinds of modified opinion as you can see. Number one, qualified opinion. So this is when there are certain misstatements, but they are not material enough to issue an adverse report. So means there are certain issues with the company, but they are not very major, and it might not impact the decision makers of the company or any of the stakeholders of the company. So the misstatements can be ignored, or they can be rectified. They are rectifiable mistakes. They are not so major so as to complain. Second is the adverse opinion. This is something that we definitely want to avoid. Adverse opinion is the complete opposite of unqualified opinion. It means that these financial statements of the company are either materially misstated, or they do not comply with the generally accepted accounting principles. Or it might be that both, they are materially misstated and they do not comply with the generally accounting principles both. This is something that we absolutely do not want, and such a company is definitely something that we cannot invest in. And finally is the disclaimer of opinion. A disclaimer of opinion is issued by the auditor I guess this statement is not properly written, but a disclaimer of opinion is issued by the auditor when the auditor was prevented from conducting a proper audit. For example, I am an auditor of the company and I went to the management. I asked them to give me their documents so that I can check them. The management says, come to me tomorrow. And every day is the same story. They are not giving me the financial statements. And one day before we are supposed to submit a report, they are giving us the report at that time. So I am not being allowed to conduct a proper audit of the financial statements of the company. In such a case, I will be issuing a disclaimer of opinion. In some people consider disclaimer of opinion to be worse than an adverse opinion. Okay, so these are the types of audit opinions, and we need to remember all four, the names and what do each four opinions stand for. Okay, so now what are the other points that we need to remember, and what are the different aspects of the notes that are mentioned in the annual report? There are other information sources, SEC filings, proxy statements, corporate reports and press releases, and earnings guidance. These are some points you need to make sure you remember, and these are not really very important, but these are certain items that are mentioned in the annual report. See, for example, I can show you the proxy statement, there will be press releases. These are information that are mentioned in the annual report which might be important and help us in understanding. One thing which is very important is earning guidance. Earning guidance is released by the company, in which they mention how the management expects the company to perform at a future date. So for example, in 21 the company had in 2020 when COVID hit, sanitizer companies and mask companies, they gave booster revenues for the coming financial year. They said that we expect 100% boost in revenue, 200% boost in profits. So that is something that we cannot predict ourselves. We need to understand the management's perspective and then make a decision. And now finally, how do we conduct an analysis? What are the steps involved in conducting a financial statement analysis? So let us understand the steps involved in conducting a financial statement analysis. Step number 1, we need to define what is our objective. Like I said, it can be that we are an investor, or we might be somebody else. We might be a creditor, we might be the government. We need to determine what questions the analyst needs to ask and what answers are we seeking so as to give direction to our financial statement analysis. After our objective is set, we know what resources we need to collect. We will go to the next step of gathering data. Next, we will go and collect data from all sources that are available to us. One of the best sources, like I already described, is the annual report of the company. Apart from that, the earnings guidance, the quarterly filings, the SEC filings. SEC is basically Securities and Exchange Commission, and it is the regulatory authority of the United States of America. Like in India, it is SEBI or Securities and Exchange Board of India. Similarly, in the United States, it's SEC. So the listed companies are required to make a lot of filings to SEC. So those are the data that might be available for the analysts to gather. Next, we need to process the data. What steps are involved in processing the data? We need to make appropriate adjustments. We need to calculate. We might be required to calculate ratios. We might be required to prepare common size financial statements. We might do several types of analysis, preparation of graphs, charts. Those are the steps that are involved in processing of the data. Next, we come to analysis. Once the data has been processed, we have the graphs in front of us. We need to analyze and determine and make our determination. For example, let us say the revenue has a trend of 10% growth every year. In 2020, the revenue was $2 million. In 21, it was $2.2 million. In 22, it was $2.42 million. Similarly, we are seeing a pattern that the revenues are growing 10% every year. So this is an analysis, and we can make a conclusion that next year we can predict that the revenues might grow to 2.86 million dollars, right? So that is something that we do in this step. We analyze the data that has been processed by us. Fifth, we report the conclusions and recommendations. Let's say if I am a portfolio manager and I need to submit my conclusions and reports to the investors that have invested money in me. After I have processed the data, analyzed it, and I have made a conclusion, I will report my conclusions and recommendations in this step. And finally, update the analysis. Basically, repeat the whole process. Every year, this process needs to be repeated. In 22, I process the data of 21. In 23, I will process the data of 22, and so on. So this is an ongoing process, and after step 5 is complete, we go back to step number 1, and everything is repeated. So now, what end of this LOS? Reading number 16. And this is a very basic reading, and just me, I will be very happy to give those to you. Now before moving forward, let us take a 10 to 15 minutes break. It is 6:22. I will be back by 6:32. Okay, so I will be back by 6:32 and we will continue with LOS 17. Okay guys, so thank you so much. I will be back in 10 minutes. Welcome back, everyone. I hope everybody's back and ready. One second. Hello. So we completed reading number 16, which was a very small reading and just an understanding of the financial statements of a company. Moving to reading number 17. So LOS 17 or reading number 17 is on financial reporting standards. Again, this page refers to the CFA Institute guidelines of what a candidate should be able to do after completing LOS 17. Let us just go through it and quickly describe the objectives of financial reporting and the importance of financial reporting standards in security analysis and valuation. Describe the roles of financial reporting standard setting bodies and regulatory authorities in establishing and enforcing reporting standards. Describe the International Accounting Standards Board's conceptual framework, including qualitative characteristics of financial reports, constraints of financial reports, and required reporting elements. Describe general requirements for financial statements under international financial reporting standards. Describe implications for financial analysis of alternative financial reporting systems and the importance of monitoring developments in financial reporting standards. Now, all this sounds so heavy and so difficult, but do not worry, it is very simple, and we will be going through each of them one by one and explaining and understanding everything with very ease. Okay, so let's move forward. First, let us understand what are financial standards, what are accounting standards. So, according to the IASB, one second. As per the IASB or the International Accounting Standards Board, the International Accounting Standards Board, which is responsible for developing frameworks for accounting standards. The objective of financial reporting is to provide information about the firm to current and potential investors and creditors that is useful. This is something that we learned back in LOS 16 also. That is, financial reporting is financial statements prepared by the management of the company, and it is prepared for relaying the information to potential and current investors and creditors who may find the information relevant in making their decisions. They may also have various other stakeholders such as the government, the public, etc. However, this is something that is given by the IASB, and accounting standards are developed by the IASB and adopted by the individual countries accounting setting authorities. For example, let us consider in the United States, FASB, that is the name of the board in USA, that is the Financial Accounting Standards Board, is the primary standard setting body that sets forth this GAAP or the generally accepted accounting principles. They set a standard guideline for all companies to follow so that the financial statements of two companies are comparable. Like we mentioned earlier, that there are different policies that companies can follow. Now these policies are something that the companies have to select from among the few options that are available to them that are mentioned in the accounting standards. Now these accounting standards are set by the setting authorities. Like I mentioned, for USA it is FASB and IASB, which is followed by the United States of America. In India it might be something, in some different country it might be something else. So they set the standard accounting standards, which then prescribe the accounting principles which companies can follow in preparing their financial statements. This allows the financial statements to be uniform over different years and across different companies, so both cross sectionally or on a time weighted on a time series level. So for a single company, if the financial statements of 2021 should be comparable to the financial statements of the same company in 2022. Again, company XYZ should prepare financial statements which are similar, not exactly same because they might follow different accounting principles, but similar to company ABC, so that we can compare the financial statements of the two company and come to a conclusion of which is better. Moving forward, what is the role of financial reporting standard setting bodies and regulatory authorities? So standard setting bodies and regulatory authorities are very important, and they are the ones that maintain uniformity. They maintain a supervision over the entire business community to ensure that the financial statements, that is the primary information for any sort of financial statement analysis, is being prepared in the right way. Standard setting bodies are professional organizations of accountants and auditors. In India, for example, it is the ICAI, or the Institute of Chartered Accountants of India, that establish financial reporting standards. Examples are IASB, like I already mentioned, and the US FASB, or the Financial Accounting Standards Body. These are the various bodies that are responsible for preparation and laying down various accounting standards. Again, now next, let us come to regulatory authorities. Regulatory authorities and financial standard setting bodies are different. Regulatory authorities which ensure that the regulations that are being prepared are followed. Basically, they are the eagles, or they are the ones that supervise the entire financial community. For example, in the US, it is the SEC, or the Securities and Exchange Commission. It will be commission. It is Securities and Exchange Commission, or the SEC. Similarly, in India, it is the SEBI, or Securities and Exchange Board of India. Exchange in India, it is SEBI, or Securities and Exchange Board of India. Now, one more word that you might see on the board is International Organization of Securities Commission, or IOSCO. Now, this is not any particular countries, but it is something that has been developed on an international level, and they just prescribe the ideal ways to conduct their operations, which might be adopted by various countries. 95% of the countries have adopted these standards that are prescribed by IOSCO. Now, most national authorities have become a part of IOSCO. IOSCO. It is in itself not a regulatory body, but its members work together to make national regulations and enforcement more uniform all around the world. So, for example, they make sure that companies in India and companies in the United States prepare financial statements which are somewhat similar. They cannot be exactly similar, but they ensure that similarity exists, so that people living in different countries can compare the results of different countries. Now, what do the regulatory bodies do? So this is something that I have not included, because this is something that if you see, you might get daunted by the very high amount of data and the confusing type of data that is there. But for SEC, yeah, they make sure that the companies are required to file a number of forms every month, quarter, and year. So there are annual forms, monthly forms, quarterly forms, and various different kind of forms which companies are required. For example, there is form SI. You are not required to remember the names of the forms. These are, I'm just mentioning to understand how the SEC ensures regulations are being followed by companies in the United States. So it might be form SI, form 10K, Form 10K is something that we saw in the annual report of Meta earlier. That is the updated financial statement. So the balance sheet and all are required to be filed in Form 10K. There's Form 10Q, Form 8Q. Such forms are required to be filed at different time periods and different events that take place. For example, if a company is wanting to issue new shares to its shareholders, a company is wishing to issue dividends, they want to pay dividends to the shareholders of the company. At any junction, whenever there is any sort of corporate action taking place, then the company is required to form certain forms. Depending on the country you are in and depending on the regulatory authority, the names and the type of form might be different, and even the filing dates. So it might be different, but every company and every country has regulations in place which make it mandatory for the companies to file such forms, so that people are being informed about the actions of the company on a timely basis. Now these public companies are getting their capital, raising capital from common people. Now, for example, I have invested my money into Meta. I do not know what the action Meta is taking next. Whether or not it will sell WhatsApp, I do not know. I have no information about anything. What Meta is going to do in the next month. So, how will I take a decision of whether or not to keep investing? To make sure that I am updated on a timely basis, these forms are made mandatory by the regulatory authorities, which in the case of United States is SEC. Now you should remember what is the roles and responsibilities of the standard setting bodies, the roles and responsibilities of the regulatory authorities, and you must also remember the name of SEC, FASB, IOSCO, and IASB. These four organizations. Please learn the names of all these four organizations, because this might be asked in your examination. Next, moving forward, let us come to financial reporting framework. There are several attributes that are considered desirable for all standard setters, and those are mentioned on the board, but I'll still read them out for you so that you know, and we'll discuss each of them. The roles and responsibilities of all parties involved should be clearly defined. So now the standard setting body should mention what the management of the company is required to do, what the accountants of the company are required to do. Even the CEO, every person should know what they are required to do to make sure that there is no discrepancy and there is no confusion among the parties involved. The professional standards should be observed by all the parties that are involved. Now, this action, even though it is ideal, it is made sure that this is done through the regulatory authorities. The regulatory authority or the SEC makes sure that the professional standards are observed by all the parties involved. That is, the companies, the management, the accountants, the auditors, everybody follows the same accounting standards. The standard setter should have adequate authority, resources, and competencies to fulfill all of its responsibilities. Now, there's a very old saying that the responsibility should be equivalent to the authority. I should not be given more responsibility than authority. If the standard setting board is expected that they will be issuing standards, then people should also follow them. They should have the right to make people follow their standards. Now this authority is given to them through law, even though the regulatory authorities are making sure people are filing. But how will people know which standards to follow? Anybody can start their own standard setting body? No. Law of each country prescribes which standard setting body is to be required to be followed by that country. So they should have the relevant authority so that they can have responsibilities. Next, the processes which guide the standard setter and the formation of its standards should be consistent and clearly defined. The so the processes of the standard setting body. For example, a standard setting body in India, what they do is this launch a draft accounting standard. Then the draft accounting standard is sent to several professionals and respected individuals in the finance industry, and then their comments are asked for. Once their comments are brought in, so changes are made to the accounting standards based on their opinions. Again, after the changes are incorporated into the accounting standards, then the whole accounting standards is accepted through a vote in the accounting commission. So there's a whole lot of process involved before any accounting standards is made official. So that process should be well defined, and everybody should know how the standards are made final. A well articulated framework with a clearly stated objective should guide the accounting standards board. Now this we will be reading about the framework at a later point of time, but we should know that there's a framework that requires that the standard setting body is required to follow. Without any framework and any rules, there is no standardization, and we are talking about accounting standards. If the standard setting body itself does not have a framework, how will they be able to form any sort of standards of their own? Next, the decision setting process should not bow to process from external forces. What does that mean? They should be independent. The decisions made by the standard setting body should not be influenced by any third party. A large number of corporations and big companies might try to coerce those large standard setting bodies into making accounting standards which are preferable to their financial statements. They might want to show their revenue in a particular way, and they might try to coerce the standard setting body into making standards in their regard. They might want standards to be made taking them into consideration. However, it should be made sure that the standard setting body is independent. They should not be influenced by any third person or their own self interests. And finally, the standards which are derived with the standard setters should be in public interest. So the standards, if there are any changes that are being brought about, the change should only take place if it results in a better presentation, or it results in financial statement being presented in a way which will be more useful and helpful to the users of financial statements. The users of financial statements being investors, creditors, other stakeholders, etc. Moving forward, before going to International Accounting Standards Board's conceptual framework, I need to tell you something. 1 second. Let us read one or two questions. Okay. So this question is, the objective of financial reporting according to the IASB framework is to, and then there are three options: provide information about the firm, decide the acceptable standards for presenting financial performance, or minimize management discretion in presenting the financial results of a firm. What will be the answer? The answer is A. The objective of financial reporting according to the IASB framework is to provide information about the firm to current and potential investors. I'm really sorry that I cannot present the questions on the board I have on the book, but I'll make sure that from the next class onwards you can read the questions that I have with me. Okay? Okay. Moving forward. The International Accounting Standard Board's conceptual framework. The IASB bases its standards on the conceptual framework for financial reporting. And as per the IFRS, what is IFRS? So IFRS is International Financial Reporting Standards. These are the standards that are followed in most countries. A lot of European countries follow the IFRS. However, certain countries have exceptions to IFRS and they have made their own accounting standards. For example, the US follows the US GAAP, or the United States Generally Accepted Accounting Principles. Similarly, in India, we follow the Ind AS, or the Indian Accounting Standards. Similarly, different countries might follow different accounting standards. However, the internationally, a large number of companies follow the IFRS, or the International Financial Reporting Standards framework. And the objective of the which objective is to provide financial information about the reporting entity that is useful to the existing and potential investors. This was the question. Remember, this is very important. The objective of the framework is to provide information to existing and potential investors, lenders, and other creditors in making decisions. So basically, the financial statements should be useful to all the stakeholders, the potential and existing investors, the lenders, other creditors in their decision making process about providing resources to the entity. So how is the IASB conceptual framework designed? The IASB conceptual framework for financial reporting is designed to assist all standard setters in developing and reviewing standards. So like I said, the IASB is not any regulatory authority. It only provides direction to other regulatory and standard setting bodies. So they provide a framework and a roadmap so that the standard setters are helped in developing and reviewing their own standards. Like I said, the process followed in India of how a draft is released, and then comments are requested from professionals. That might be something that is recommended by the IASB. So IASB might recommend that this is how you might launch a new standard. Next, it helps auditors in forming an opinion on financial statement. The IASB conceptual framework, since it is providing a standardization for all financial statements, it is helping the auditors in forming an opinion on financial statements. I hope you do understand that auditors or the public accountants of any company are required to form an opinion. Like we read in LOS 16, that public accountants are required to issue an independent opinion giving a reasonable assurance of whether the financial statements of the company are free from any material misstatement. All the words that I'm using are very important, so please make sure to keep those in mind. So it helps the auditors in forming an opinion on the financial statements. It helps the preparers of financial statements. Who are the preparers of financial statements? The management. The management prepares. The management of the company is responsible for preparing the financial statements. So it assists the preparers of financial statements in applying standards and dealing with issues which are not specifically covered by the standards. So for example, the standard might mention that there are three options. You can value inventory in three ways: market value, present value, future value, whatever. But how will the management know which to follow? Now, in this case, the ISB may come forward and they might issue guidelines and help documents which might help the preparers of financial statement to determine which accounting principle or accounting standard is applicable and relevant to them. And finally, assist users in interpreting financial statement information. Now, everything finally comes down to financial users understanding and being able to analyze the financial statements in the proper and correct way. So since the IASB is providing an ideal roadmap to the standard setting body to prepare their own accounting standards, this ultimately is helping the users of financial statements to make their decisions by interpreting and analyzing the financial statements in the correct way. I hope you do understand what I'm trying to say. In case you have any queries, feel free to reach out to me. You can, in case you are watching from YouTube, feel free to leave a comment on the video and we will be replying to them. Okay, so now there are several qualitative aspects to financial statements which are very important. So these, in the absence of these qualitative aspects and qualitative characteristics of financial statements, the financial statements will not be very important, will not give any information to the users of financial statements. So what are these qualitative characteristics? There are two fundamental characteristics and four other characteristics. We need to remember all six. Okay, move first, starting with fundamental qualitative characteristics. Relevance, number one is relevance, and number two is faithful representation. So financial statements should be useful both for making forecasts as well as to evaluate the past forecasts. What does this mean? If I am giving an information in my financial statement, it should help me understand what has happened in the past, and it should also help me in making a forecast. For example, now let us come back to this meta. See, so in these financial statements, you can see that they have presented the data for 2020 and 2021. So they have given information about the past, that is 2020 and 2021. Both are past. Do not think that 2021 is future. 21 is also the past. It has happened. So they are giving what has actually happened. And now we can see that for the company, over the course of years, 2019 the revenue was 70,000 million. 2020 their revenue was 85,000 million, and 21 their revenues was 118,000 million. So this is giving us a trend, how the revenues are increasing year after year. So this is helping us making a decision. Now we can predict that in 2022 the revenues of Meta might be 130,000 million dollars. So this is giving us predictive power, and using these financial statements, it is relevant to us because it is not only helping us understand what has actually happened in the past, but it is also helping us to understand what might happen in the future. It is giving us forecasting abilities. Next, faithful representation. Information should be complete, neutral, and free from any errors. Now coming to this, what if I tell you, if I say, let us say that the company has written 118,000 million, but in reality, in 2021, the company actually earned 84,000 million dollars. That is a material misstatement. So in case the company is faithful, that will not happen. So faithful representation of all the values in the financial statement is very important. Information present should be complete, neutral, and free from all errors. So relevance and faithful representation are two of the most important fundamental qualitative characteristics of the financial statements. You need to remember both of them, and you can be asked whether or not relevance and faithful representation are fundamental qualitative characteristics. Alternatively, you might be asked whether timeliness is a fundamental characteristics. What will your answer be? So we will read later that timeliness comes later. It is not a fundamental characteristics. So do remember that these two are the fundamental characteristics, and there are other four which are not fundamental, but those are also important. Coming to the next four characteristics: comparability, verifiability, timeliness, and understandability. I'm pretty sure that you all can guess what those mean, but we will go through every single one of them so that you can remember them when you are asked in the exam. We will try to read everything in such a comprehensive way so that whenever you're sitting in the exam, if you watch just the videos, then also you will have something in your mind so that you can attempt every single question that has been asked in the exam. Okay, so I understand that today's class is very theoretical, so please do not get bowed down by it. We will coming to practical questions soon. Stay strong and keep learning. Okay, so let's start. Comparability permits the identification and understanding of similarities and differences between information. What does this mean? That whatever information we are being provided, it should be comparable. Comparable not only between companies but different years of the same company. Like I said, when we look at this information, we are being able to compare the revenues of Meta over the different periods of time. So this is giving us the right to compare. We are getting the ability to compare different informations about the same company. If every information, for example, revenues included different items every year, we won't be able to compare it because we cannot compare apples and oranges. We need to compare apples with apples, right? So comparability is very important. So, and that, as we have already learned, is done through the accounting standards and accounting principles that are followed by the companies. Next, verifiability. Verifiability means different observers would independently agree that the information presented faithfully represents the economic phenomena that it alleges to present. What does this mean? Let's say Mr. X is the accounting of Meta, and he has stated that the revenues are $85,000 million. Now next day they hire a new accountant. They fire Mr. X and they hire Mr. Y. Mr. Y joins, and day one he says that everything done by Mr. X is incorrect and the actual revenue should instead be $100,000 million. So does that give any verifiability to the work done by Mr. X? No. We should make sure that the work done is verifiable by different people. So the data that is presented in the financial statements should be verifiable. Different people should interpret the data in similar ways. If you are saying that the revenue of company X is 100,000, then I should be able to understand that revenue means the sales of goods or the sale of services of that company. I should be able to understand and verify what you are saying. That is the meaning of verifiability. Next, timeliness. Timeliness refers to the availability of information to the decision makers as and when required. Let us say that I am a investor and I need to make an investment in Meta. To make an investment, I need information about the financial statements. However, when I asked for the information, I received the information 1 month later, and my financial statement analysis was delayed by 1 month. During that 1 month, the share value of Meta rose by 10%. So I made a loss. So was that relevant then? Was that useful? That data is no longer useful to me. I could not invest it on time. So if I'm not being able to use the information about the financial statements on time, then it is not useful. So the conceptual framework mentions that the data and information should be available to all the decision makers as and when it is required. That is, before the decision making need arises. And finally, let us come to understandability. Understandability means that the information should be comprehensible to its users who have a reasonable knowledge of business and economic activities. So make sure what it is saying. It is saying that it should be understandable. Comprehensible means understandable. It means it should be understandable to people who have knowledge. It does not mean that any XYZ can go and understand the information. We need to have knowledge of financial statements. We should understand what do accounting standards mean, what do accounting policies mean, what do accounting estimates mean, and the meaning of the different terminology in finance. If I am saying revenue, if I am saying operating expenses, operating revenue, operating profits, I should be able to understand what do different words mean. So only those people who have a reasonable knowledge of business and economic activities, and it should be understandable to them. So what kind of question can you get? Mr. XYZ is a science professor. He has never seen a balance sheet in his life. He opened the balance sheet of Meta and he cannot understand anything. He says that it is nonsense and it is not relevant. It is not following the conceptual framework of the standard setting bodies. It is not following anything. So is he correct? Will you say that the balance sheet of Meta is not following the framework and it is not following the qualitative characteristics of understandability? No. It should be understandable to the people who have knowledge of business and economic activities. Okay, so once we should revise, fundamental qualitative characteristics are relevance and faithful representation, and other characteristics are comparability, verifiability, timeliness, and understandability. Now, International Accounting Standards Board's conceptual framework, what are the elements that are required to be reported? As we have already discussed this in LOS 16, but let us go through this again. So in the statement of financial position, what are the things that are recorded? Number 1, assets. Number 2, liabilities. And number 3, equity, owner's equity. Those 3 are mentioned here. And for financial performance, that is statement of comprehensive income, income and expenses. So revenue is the income and expenses. These are the expenses. So these are the things that are mandatorily required to be reported in the statement of financial position and the statement of financial performance. Without these, there is no meaning. So again, the kind of questions that can be asked from this section, like we have already discussed, they can mention any one point and you have to mention in which statement will they appear, whether they will appear in the statement of financial position or the statement of financial performance. So let me ask a few questions and you answer in your mind. I hope everybody will go along with this, okay? Let's say machinery. I am a manufacturing company and I bought a machinery. Where will this be reported? In the statement of financial position or the statement of financial performance? Correct. A machinery is an asset. It is something that will help the company to earn future profits. So it is an asset to the company and it will be recorded in the statement of financial position. Let us do one more. Let us consider I bought, let us say I made payment for a advertisement pamphlet, advertisement. So where will this appear? Advertisement is an expense to the company. So it is an expense. So where will an expense appear in? Correct. It is in the statement of financial performance. So assets, liabilities and equity for financial position and income and expenses for financial performance. Now let us just briefly understand what do each word mean and then we will move forward. So assets are the resources that are controlled by the company as a result of past transactions. For example, I need to buy the machinery. So that purchasing is the transaction that took place for me to own the asset, that are expected to provide future economic benefits. So what do assets give us? Future economic benefits. This is the word that is relevant for assets. So assets will give us future economic benefits. What about liabilities? Liabilities are the obligations that again occur due to past events. So assets and liabilities occur due to past events, which is expected to require an outflow of economic resources. Outflow of economic resources in the future. So liabilities will result in an outflow of economic resources in the future due to past event. Again, let us consider what is a liability. A creditor. Suppose I bought the machinery on credit. So I did not pay him then. The creditor is recorded as a liability because it is a past event. The transaction of buying the machinery took place, and it will result in a future outflow of economic resources. I will have to pay the creditor at a future date of time. So that outflow of economic resource is referred to as a liability. Next comes equity. So equity is the owner's residual interest in the assets after deducting the liabilities. So assets minus, this is something we have already discussed, but still. So equity is the excess of asset over the liabilities of the company. This keeps on changing. Okay, coming to the statement of financial performance, let us look at income. So what is income? An income is, what is an income? An income in economic benefits, either increasing assets or decreasing liabilities. So income is any sort of economic benefit that we are getting. For example, a sale of my good. I am a salesperson and I sell my good. So that sales transaction is my income. I am earning an economic benefit which results in an increase in asset. What is an asset that is increasing? Cash. So I am selling my goods and increasing cash. So that is an income for the company. And what about expenses? Expenses are decrease in economic benefits. So we can write increase in economic benefits. And for expenses we can write decrease in economic benefits. Okay. So the decrease in economic benefit from expenses results in either decreasing assets or increasing liabilities. So in this case, now let us look at how it increases liabilities. Let us take an example of advertisement expense. So we said that we are incurring an advertisement expense. If we do not pay the creditor, we do not pay the advertising agency, we will have to pay them at a later point of time. So that will be recorded as a liability. It results in an increase in liability for the company. So expenses result in either a decrease in asset. If we pay them at as and when we incur the advertisement expense, then it results in a decrease in cash. So either our cash is reduced and we get advertisement, or our liabilities is increased. That is, we record a creditor and an expense is incurred. This is how we describe income and expenses. Okay, let's move forward. Next comes the measurement base. So what is measurement base? The amounts at which the items are reported in the financial statements depend on the measurement base. It can, so I've already discussed this once, I remember. The measurement base can be anything. A person might record the assets or liabilities as per historical cost, amortized cost, current cost, realizable value, present value, or fair value. These are the measurement bases that we are going to read. Okay. Again, this refers to what amount should be recorded in our books of accounts or our financial statements for every single line item. It might be an asset, liability, income, expenditure, or owner's equity. What value or what amount should be right? Now, some people might ask, it's very obvious the amount that we paid, but that is not necessary. Let us take an example. Let us say that Mr. X buys a machine for $100,000. He buys a machine for $100,000 on 1st January 2021. Now, At what value should Mr. X record the machinery in his statement of financial position on 31st December 2021? At what value? Should he record $100,000 only? That is the historical cost or the cost actually paid. Or the current rate in the market for the same machinery is $120,000. So should he record $120,000? If neither, then what about historical cost minus certain value for the depreciation, the decline in value for the use that we have already done, minus depreciation? This seems logical, right? That is, let us say 10%, so $90,000. There are different ways. So what value should we record it in? These are the various measurement bases and are mentioned by the accounting standards. So let us read and understand what do the different measurement bases stand for. You need to remember everything, and in the exam you can be given a scenario of what are the different values, and you need to say which one refers to historical cost, which refers to amortized cost, etc. First, understanding historical cost. Like I already mentioned, it refers to the actual amount of cash or cash equivalents which is actually paid. So it's mentioned fair value. I'll give an example. For example, instead of paying in cash, if we do a barter transaction, if I do not pay you $100,000, instead I give you my car. So if I give you my car, which is worth, let's say, $100,000, then the value of the car will be considered to be the value of the new asset that I have purchased. So that will be referred to as the historical cost. That is the cost which was paid, the price which was paid at the time of buying the asset. That is the historical cost. Next comes the amortized cost, which seems to be the most fair and which is actually used by companies. It is the historical cost minus adjustments. What are the adjustments? It might be depreciation, it might be impairment. We'll discuss impairment at a later point of time, or in rare cases it might also be an increment in value due to the large increase in the fair value of the asset. So those are rare cases, but let us just say amortized cost refers to historical cost plus and minus any adjustments to the historical cost, which generally is depreciation in a standard basis. Next is current cost. Current cost refers to the cash or cash equivalents that is required to be paid for the same asset today. So let us say I bought a mobile phone. I bought an iPhone 14 for $1,200 1 year earlier, and 1 year later it is worth only $800. So the $800 refers to the current cost of the iPhone. So that is a measurement base called current cost, where the assets are recorded at the value prevailing in the market at that time. Realizable value. Realizable value refers to the amount that you can reasonably expect to obtain by selling the asset. So like I said, the value of the iPhone is $800 today, which I bought for $1,200 last year. But I cannot expect to get $800 today. It is available to be purchased from the market for $800 from Amazon. But I will not be able to sell my asset for $800. If I sell my phone for my second-hand iPhone, I might only recover $300 from it. So that $300 will refer to the realizable value. It refers to the amount of cash or cash equivalents that could currently be obtained, reasonably expected by the management if we dispose the asset today. Present value. I think present value is something that Pankaj sir explained to you all very well yesterday, and it is something that is ingrained in your mind. So concerning assets, this refers to the discounted future cash value that is expected to be generated during the normal course of business. So I think everybody knows what is present value from Pankaj sir. If you have any clarifications required present value, I think Pankaj sir will explain to you in your next quants class. And finally, we come to fair value. Fair value refers to the amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties at arm's length. So this is confusing now. What is the difference between present value? What is the difference between realizable value and fair value? So for a very good example, to understand this concept, let us consider a company in distress. Okay, I am a company which is going through bankruptcy and I will have to liquidate all my assets immediately if I need to save my company. For such a company, since the time to sell the asset is very low, I might be able to recover a lower amount than the fair value of the asset. For example, like I said, the iPhone is worth 300. The realizable value, the fair value is $300. However, since I want to sell it today only, I want to sell my asset today itself, I might only recover $200 instead of 300. So that is the difference between the fair value and realizable value. The actual realizable value might be lower than the fair value of the asset. Okay, so this covers the entire measurement base. I hope that we are all through with it and you understand every single concept of measurement base that has been taught today. Okay. Okay, so before moving forward, we will take another 5 minutes break. Our break is from 7:25 to 7:30. So we'll be coming back at 7:30 IST. Let's take a 5 minutes break. I'll see you back in 5 minutes. Welcome back. Welcome back, everyone. I hope everybody has taken their break and is re-energized. So let's move forward. So now we will be learning about the constraints of the conceptual framework and two important assumptions. First, let's start with constraints. Trade-off between reliability and timeliness. I'm sorry. So there's a trade-off between reliability and timeliness. What does this mean? While preparing the financial statements or while developing the conceptual framework, the more time that we devote to the preparation, the better it will turn out to be. However, there's a trade-off. We do not have all the time in the world. There is some point then at which we must stop and we must submit our work, right? This is a major problem that perfectionists face. They just keep on trying to perfect their work, but there is no end to it. You need to stop at some point and you need to understand that there is a trade-off. You need to understand that reliability has to be good enough. There should be reasonable reliability, and the work should be completed within the due date. If the financial statement analysis is not complete within the time allocated to it and the decision making is delayed, then what is the point of the financial statement analysis itself? So there's a major trade-off, and that it is between the reliability and timeliness. Next is the cost involved. So the conceptual framework involves a lot of cost. So for example, let us say the preparation of financial statements and the compliance with accounting standards. You need to hire a lot of public accountants, you need to hire accountants, you need to make sure that there are company secretaries involved, there are public accountants involved who are making sure that everything is being done in the proper way. All these involves a lot of costs, and there is a limit to which the company can spend their money, and the amount of budget that is available towards the development of the financial statements. That refers to the constraint of cost of financial statement framework. And finally, intangible aspects. There are several intangible aspects that are involved, such as the understanding and such as the decision making of the individual who is involved. There are these are certain what do you say, intangible aspects that needs to be considered before conducting any sort of financial statement analysis. We have completed this. Let us just huh. One more constraint which I forgot to write is non-quantitative information. So the financial statements do not give us non-quantitative information. So when we see at financial statements, we already read that it includes the balance sheet, that is the statement of financial position, the statement of financial performance, the statement of cash flows, and the statement of changes in equity. So these are covered under the financial statements. What is there in these statements? Numbers, and a lot of numbers. However, if we need any information which is beyond numbers and we want some qualitative information, that is not there in the financial statements, and that is a major constraint of it. However, when we read the annual report, for example, I gave you information that the management discussion and analysis, the future predictions of the management, and other information, several information that is mentioned in the annual report needs to be read in totality to get an understanding of where the company is headed. So that is something that we need to understand. Everything needs to be considered in totality, and the lack of non-quantitative information can be considered to be a constraint of financial statements and the conceptual framework of it. For preparation of financial statements, there are two major assumptions that we make. Number one, accrual, and number two, going concern. What are these assumptions? And these are very important for you, because whenever we are going to read anything, we need, even though these are not relevant, very relevant for exam questions purposes, but this is very important for understanding how financial statements are drafted and understanding the whole concept of financial statements. If we do not understand these, then we won't be able to make any sorts of judgment or decisions in our financial statement analysis. Coming to accrual basis. So the entire financial statements is drafted on an accrual basis. This means that revenues and expenses are recorded not on cash basis, but as and when they happen. Like we said, when we buy a machinery, on credit, if the machine was purchased on credit, then under cash basis it would not even be recorded in our books of accounts. But we know that we have bought a machine, it is in our hands. So what is the transaction that is taken place? Machine account debit to creditor. You don't need to understand the accounting portion, but we need to understand that the accounting is done when the machine is purchased or not, and not when actual cash outflow is taking place. We do not consider cash outflow or cash inflow as the only date of recording transactions. The transactions are recorded as and when they happen, and recognition of those transactions take place on an accrual basis. This is an example of an asset, and similarly for a liability, let us say this is a liability. So the creditor is the liability and the machine is the asset. So these are recorded on accrual basis. Next, coming to going concern. What does this mean? This means that the accounts are prepared considering that the company will continue its business for an endless period of time. We do not have an end date for the company. What will happen if the end date is given to us? Let us say there are certain companies which exist only for 2 years, for 3 years. There are companies, for example, I am a builder and I was hired by the United States government to build a bridge. And to build the bridge, I formed a separate entity, a separate company just for the purpose of construction of the bridge. I know that the bridge will be constructed within 3 years. So in the memorandum of association of the company, I mentioned that the life of the company is 3 years. In that case, the going concern principle or the going concern assumption is not applicable. However, for most companies, the going concern principle holds, and the accounts are recorded on a going concern principle. This means that whenever we record the values, we know that the benefits of the assets will be accrued for an endless period of time till the asset is discarded, or the liability will be paid off at a future date, and we might not know the date of time. However, for a 3-year company, the company which I mentioned in my example, let us say that company, I know that after 3 years, I will have to dispose of that asset. So recording the asset at amortized cost in such a case might not be the ideal way. I might be better off recording it at present value. So that is a major assumption that we make, that the company is going to continue its business for an endless period of time. That is, we do not know that when the company is going to end its business. If we know, then the entire accounting might be done in a different way. So these are the two most important assumptions that we need to remember. Okay. We are almost towards the end of today's class. We only have 3 slides left. Okay, 4 slides. So let's start with the final 2 sections of our today's class. What are the general requirements for financial statements? Again, this comes back to what are the components of financial statements. What is considered to be a complete set of financial statements? We have already read about the statement of financial position, the statement of financial performance, which is mentioned as statement of comprehensive income, statement of cash flows, a statement of changes in the owner's equity or the statement of changes in equity, and finally explanatory notes and summary of accounting policies. Remember, the notes are also a very important part of the financial statements, and without the explanatory notes it is not complete, considered to be complete. You need to know that there are 5. Whenever you are asked, all 5 of these are considered important for a financial statement set to be complete. This can be an important question of that. The question can be framed like a balance sheet, PL, cash flow and owner's equities given to us. Does this form a complete set of financial statements? We have to write no. Without the explanatory notes and an explanation of the accounting policies, it is not a complete set of financial statements. Okay, so what is IAS? We have written IAS here. We have again written IAS. What is IAS? The eraser is not working. No issues. Okay, so IAS refers to International Accounting Standards. So we have used it carelessly here, but this is the accounting standards that has been issued by the international authority. And just we are going to read through the basics and the important features which are mentioned in IAS 1, which has been specified by IAS 1 for preparation of financial statements. Number 1, fair presentation. Number 2, going concern, accrual basis, materiality, aggregation, no offsetting, reporting frequency and comparative information. These are the general features that have been mentioned in IAS 1. Let us go through these one by one. Number 1, fair presentation. As described by IAS, fair presentation requires the faithful representation of the effects of transactions, other events and conditions as per the definitions and recognition criteria for the assets, liability, income, expenses set out in the framework. This again comes back to what we have already read, that the values that has been presented should be verifiable. What were the 4 characteristics? Who can tell me? Do you remember? Comparability, verifiability, timeliness, understandability, and the 2 fundamental characteristics were relevance and faithful representation. So this is something that we have already read. So coming back, it should be fair presentation. This again, this basically covers faithful representation, and the value should be something that should be correct and fair for the assets and liabilities that is being presented in the financial statements. What does the statement mean when they say they should be as per the conditions of the condition and the recognition criteria? We'll be learning the revenue recognition criteria in the next class, so you will be able to understand what we mean by the recognition criteria. But just know for information right now that all assets, liabilities, income and expenses have a recognition criteria that has been mentioned in the accounting standards. So those recognition criteria should be met before they are recorded in the financial statements. No company should be violating any of the accounting standards and should fairly present their financial statements. Coming next to going concern. Going concern we have just discussed in detail, but let's read what's written here. A company's financial statement should be prepared on a going concern basis unless a company's management intends to liquidate the company, cease trading, or has no realistic alternative but to do so. What does this mean? That the financial statements must follow the going concern assumption that we discussed in the previous slide, unless the company is going to go bankrupt, they do not have any money left, so they have to liquidate the company. That is, they have to shut down the company, or they are going to cease trading. That is, the company is closing their operations. It might not be due to bankruptcy, it might just be the management's decision that they do not want to run the company anymore, or they have no realistic alternative but to do so. Like I said, in the case of the bridge company, if the memorandum of association or the core document of the company mentions that the company's life is only 3 years, then the company has to be shut down after 3 years unless certain legal procedures are followed, which we are not going to discuss. So the company has no realistic alternate but to close it. Then only under these circumstances should the going concern assumption be ignored. Except for these, the going concern assumption is something that should always be followed while preparation of the financial statements of the company. Next, we come to accrual basis. Again, this is also something that we discussed in the last slide only. However, we'll just go through it again. The accrual accounting should be used when preparing financial statements, except where cash flow information is involved. So the statement of financial statement is the only statement where accrual basis is not followed, because cash flow statement specifically mentions that it is going to present data relating to the cash flows of the company. Now let's come to new data. Materiality. This is something new. Whenever I have said about audit, what is the statement that we have used? We have used the statement that the auditor gives a reasonable assurance that the financial statements that have been prepared by the management is free from material misstatement. Right? So what is material? What is material in this case? For a company like Facebook, we saw that its revenues were in $100,000 million. Do you think $10 will be relevant or material? If there's a discrepancy, or by mistake they have said $10 less or $10 more, that will not even be present in the financial statements, because it will be 0.0001, something like that. So do you think that is relevant or material for a company like Facebook, Meta? No, it is not. So we should understand materiality company by company basis. We should understand what information or what amount will alter or affect the decision makers of the company. That is, if I am an investor of the company, I will want to know if $100,000 have been stolen from the company. That is something that I might consider relevant. So those kind of data which are relevant, it depends from company to company. If it is my company and I opened a company which has a total value of $10,000, then even $10 will be relevant for my company. But for a large public company trading for hundreds and thousands of millions of dollars, it might not be relevant. So again, we need to understand materiality from a company to company perspective, and we need to make sure that material misstatements are not in the financial statements. Next comes to aggregation. Material classes of similar items are clustered together. Now let us see material items of similar items. Here it is written property and equipment. Do you think that it only means building that the Facebook offices or the Meta offices? Or do you think it also means their servers and their computers? So all these assets can be broadly classified as fixed assets or property, plant and equipment. Hence they have been aggregated into one line item. All the buildings, the machinery, computers of Facebook have been presented in this one line item. So they have been aggregated into a single line item for ease of understanding. If we want to get the breakup and details, we can go into the notes of accounts to get them. But aggregation of all material classes of similar items are necessary for easier understanding of the financial statements. Next, no offsetting. So what does this mean? Apart from what is permitted under IFRS or US GAAP, there should be no offsetting. Any asset and liabilities should not be set off. Example, our very old example of buying a machinery for credit. I bought a machinery for credit for $100,000. So the machinery is worth $100,000 and the creditor is worth $100,000. Okay, in my books of accounts, there's an asset, there's a liability. Can I show the machinery minus liability? Can I show them as net, as a net figure? Can I offset the two figures? It is not permitted. However, there are certain items which are permitted to be offset. For example, it might be as per IFRS, the provisions that is created for debtors. Like I sold a machinery to Mr. X and I do not expect to receive the money back because Mr. X is going bankrupt. So I have created a provision in my books of accounts of $100,000 that I might not receive the amount from Mr. X any longer. So I might be allowed to offset those two amounts and I might be allowed to show the current asset as this asset minus the provision. However, we need to make sure that IFRS or the accounting standard of the country that we are in allows those offsetting before making any offsetting transactions. Next, reporting frequency. This simply means that the financial statement should be reported on a regular basis, at least annually. Every company is required to prepare the financial statement at least annually. For public companies and listed companies, it might even be quarterly or monthly even for some countries. Okay. Finally, last, we come to comparative information. Again, coming back to the meta balance sheet, we have been provided the information of 2021 and 2020. So the value of 2020 is the comparative information. It is mandatory required by IAS number 1 that comparative information about the company's past should be presented along with current data. So whenever we are presenting the data for 21, the data for 2020 should also be present so that we can compare the two and get a better understanding of the situation of the company. The structure and content of the financial statements inclusive of the following. Okay. So now come to what are the structure and the content of the financial statements. Let us start with classified balance sheet. Again, we'll go back to our favorite example. What is classified in this? Can you see? Can you give me an example? Let's see. So assets is the primary classification is assets and liabilities. The entire balance sheet has been divided into two parts, assets and liabilities. Next, the assets have been broken down into current assets and others. These are long-term assets. So this is another classification. The liabilities are also have been broken down into current liabilities, other liabilities, and shareholders' equity. So these are the classifications of the balance sheet. The balance sheet should distinguish between current and non-current asset, current and non-current liabilities, unless a liquidity-based presentation is deemed to be more relevant. So liquidity-based presentation is something that is not relevant for you, and we will be discussing that at a later point of time. But for now, let us understand what is the meaning of current and non-current assets. In brief, let us just go through it quickly. So current generally means any asset or liabilities that is expected to be realized within 1 year or 1 operating cycle, whichever is longer. So for example, let us say I have cash. I expect to spend that cash within 1 year. So will that be a current asset? Yes. But if I have a machinery, I have a computer, do I expect to sell the computer within 1 year? Now I expect to use it for at least 3 to 4 years. So that will be a non-current asset for me. However, let us take the example of something else. Let us take the example of a construction company. A construction company builds a building and sells it to its customers over a period of 2 years. The whole process of starting the construction and selling the building to its customers takes 2 years. So in this case, for classification to between current and non-current, we won't be considering 1 year, because the operating cycle of the company, that is the start of the construction till the sales, is more than 1 year. It is 2 years. So in this case, any asset which is asset or liability which is expected to be realized within a period of 2 years will be considered to be current, and any asset or liability which is expected to be realized beyond the period of 2 years, that is beyond the operating cycle of the company, will be considered to be non-current. I hope I am clear with this, but if you have any queries, please feel free to contact us at any time. Next, let us come to minimum information. Minimum line item disclosure on the face or on the notes to the financial statements are specified in IAS 1. It also specifies the disclosures that must be made on the financial information which is to be presented in the financial statements. So it basically means what are the minimum line items that have to be disclosed. For example, IAS 1 states compulsorily that assets, current assets, cash and cash equivalent, marketable securities, account receivable, etc. All these items are mandatorily required to be reported. So this is the minimum information that according to IAS 1 is required to be reported. Even in the notes to accounts, the IAS 1 specifies what is the minimum information. A company at its discretion might make extra information available to its shareholders or the users of the financial statements, but the minimum information that is required to be disclosed by the company is mandatory and stated in the IAS 1. And finally, comparative information. Comparative information is something which I have already discussed with you time and again, I think. So the previous reporting periods information should also be presented along with the current period's financial statements unless otherwise permitted by another standard. Like this, we have already seen that the previous financial year's data is also presented along with current year's data. So that is mandatory as per IAS 1. Finally, we come to the last and final slide of today's class. Before we go on to go through the entirety of what we have done today, let us see monitoring developments in financial reporting standards. So the financial standards keep on updating and changing as per the better understanding of the standard setting board. The standard setting board might time and again change things depending on the scenario and the companies that are evolving. For example, one of the biggest things would be the emergence of e-companies or the emergence of app-based and website-based companies. This has created a whole new environment, and it has become very important for standard setting bodies to create new standards so for these new companies, so that their revenues can be recognized as and when they incur. This is why a completely new and revamped revenue recognition principle was introduced with the advent of e-companies or electronic internet and app-based companies. So these changes keep on taking place, and as financial analysts, we should make sure that we are updated with every single change that is taking place in the financial standards, in the accounting standards. The financial reporting standards are evolving rapidly. It is therefore important for analysts to closely monitor the developments in case the standards are and continuously assess their implications for security analysis and valuation. This monitoring can occur in many facets, including new products like I said, the advent of internet-based companies, actions of standard setters and other groups represent, and company disclosures regarding critical accounting policies and estimates. So these are certain cases where the company might be required to make any changes. if a company launches a new product, then the new revenue recognition principle might be applicable to the company, and the company needs to make sure that they're following it. And the financial statement analysts should make sure that while interpreting the financial statements, they are keeping in mind the new accounting standard that the company is starting to follow. These are the things that might lead to changes in the accounting standards, and we need to take care of them. So we have completed both LOS 16 and LOS 17 today. Before ending the class, let us just quickly go through both of them. In LOS 16, we went through the difference between financial reporting and financial statement analysis. Financial reporting refers to the statements that are prepared by the company management of the company, whereas financial statement analysis is done by analysts considering the financial reporting. They take into account the financial statements, the management discussion and analysis, and other important information that is presented in the annual report to prepare a financial statement analysis. Then we came into the components of financial statements, which includes the statement of financial position or the balance sheet, the statement of comprehensive income or the profit and loss account, the statement of changes in equity or the statement of changes in owner's equity, and the statement of cash flows. Then we went into footnotes, audit and analysis, where we read about what information is present in the financial statement notes, which includes the accounting policies, accounting methods, estimates, assumptions, the acquisitions and disposals being done by the company, the contingencies, legal proceedings, employee stock options, and other information. The management commentary, which might include additional information which might be relevant for the people who are doing financial statement analysis. It might include, for example, an app-based company, it might include the data about the average daily users or the average monthly users, and it also includes the management's expectation of where the company is heading. Then we went on to audit and understood the meaning of audit, which means audit is an independent review of the entity's financial statements conducted by public accountants. It is an independent review, giving us a reasonable assurance of whether the financial statements are free from any material misstatements or not. Then we went on to the meaning of internal control. Internal control is the responsibility of the management of the company. They must make sure that the internal control requirements are in place and that the company is conducting this operation in the correct way. Then we went to the various types of audit opinion, which number one is unqualified opinion, which is that means that the entire financial statements are free from any material misstatements and in accordance with the generally accepted accounting principles. Then the next three opinions are combined, called modified opinions. Number one, qualified opinion, which means that even though there are some discrepancies and there are some things which are not in accordance with GAAP, however, the rest of the financial statements are fairly presented and it is okay. Number two is adverse opinion. It is the opposite of unqualified opinion. That means that there are material misstatements and there are material discrepancies from the generally accepted accounting principles. And disclaimer of opinion, which means that the auditor was not allowed to conduct the audit in a proper manner. Finally, we came to what are the components of footnotes or the other informations. The other information sources are Securities and Exchange Commission filing, proxy statements, corporate reports and press releases, earning guidance. These also form a part of the annual report of the company, which help a financial statement analyst in making the analysis. And finally, the financial statement analysis framework. The framework includes the state of objective. I'm really sorry. Number one is state the objective and context. We need to understand what is the objective and why we are conducting the financial statement analysis. Number two, gather the data. Gather the data for the financial statement analysis. It might be the financial statements, the management discussion and analysis, and several other data that might be available to the company. Next, we need to process the data. This might involve including financial ratios, graphs, charts, and understanding the data. Number four is analyze and interpret the data. Once we have processed the data, we need to analyze and make our conclusions on the processed data. Number five, we need to report our conclusions and recommendations, because our conclusion and recommendations might be important for some people. And finally, we need to update our analysis on a regular basis. The entire process needs to be repeated and we need to state the objectives again, gather the data again, process the data again, analyze it, report it again. That is the entire financial statement analysis framework. This is all that we read in LOS 16. And now a quick go through of LOS 17. Let's start with the role of financial reporting standard setting bodies. We realize that standard setting bodies are different from regulatory authorities. Standard setting bodies are professional organizations of accountants and auditors that establish financial reporting standards, and their responsibility is to set up new standards. And regulatory authorities are government agencies that have the legal authority to enforce the compliance of financial reporting standards. We read about the standards, several attributes that are considered desirable for all standard setters. Which these were: roles and responsibilities should be clearly defined. Professional standards should be observed by all parties that are involved. Standard setters should have adequate authority compared to their responsibilities. Processes which guide the standard setter and formation of its standards should be consistent and well defined. A well-articulated framework with a clearly stated objective should guide the accounting standards board. The decision-setting process should not bow to pressure from external forces. That is, the decision-setting body should be independent. The standards which are derived by standard setters should be in public interest. Next, we come to International Accounting Standards Board's conceptual framework. The conceptual framework is designed to aid all standard setters in developing and reviewing standards, aid auditors in forming an opinion on financial statements, aid preparers of financial statements in applying the standards and dealing with the issues which are not specifically covered in the standards, assist users in interpreting the financial statement information. Then we come to the qualitative characteristics of the financial statements. Now, the two fundamental qualitative characteristics are relevance and faithful representations, and the four other characteristics are comparability, verifiability, timeliness, and understandability. Next, we come to the components or the reporting elements. For financial position, they were three: assets, liabilities, and equity. And for the statement of financial performance, they were income and expenses. Next, we come to measurement base. What were the measurement bases? The 6 measurement bases: historical cost, which means the cost that we purchased for; amortized cost, which is historical cost, minus plus the adjustments; current cost, which is the current cost for which the asset is available in the market; realized cost, realized value, which is the value which we must realize at sale of the asset; present value, which we have already discussed in quants; and finally fair value, that is the fair value of the asset or liability. Next, we come to constraints. Constraints were the trade-off between reliability and timeliness. We need to do the work reliable and within time. Next comes to the humongous cost that might be involved, so we need to make sure that we are doing it in a cost-effective manner. And finally, the intangible aspects, that is the mental aspect of that might be involved. And also, we also discussed about the non-quantitative information, which might also become a part of the intangible aspects. And then we come out the two important assumptions that we have made in preparation of the financial statements, that is the accrual basis and going concern. Accrual means that transactions are recorded not on cash basis, but as and when they take place. The movement of cash is not required for transactions to be recorded. And next, going concern principle, the going concern assumption, which means that we assume that the company will continue its operation for a foreseeable period of time. Next, we came to what is a complete set of financial statement. It includes a statement of financial position, a statement of comprehensive income, a statement of cash flows, a statement of changes in owner's equity, and finally, and not lastly, सबसे important, most important, explanatory notes including a summary of accounting policies. Then we read about the IAS number 1, specific general features for preparation of financial statements, fair presentation. We read about fair presentation of how all information should be fair. Going concern, we have already talked about it. Accrual basis, materiality, the amounts that should be material should be fairly represented. Aggregation, there are several material classes which are similar, should be grouped together. Next, no offsetting. Unless specifically allowed by the accounting standards, asset, liabilities, income and expenses should not be offset. Reporting frequency, a company should report its financial statement at least annually. Comparable information, they should present comparable information in their financial statements. Next, we come about the structure and content of the financial statements. Classified balance sheet. We showed you the balance sheet of Meta, where current asset, non-current asset, everything was classified. Number two, minimum information. The IAS specifies the minimum information. For example, IAS must mentions that it is mandatory for you to classify information between non-current and current asset. That is a mandatory requirement by IAS. So that is the minimum information that we need to present in our financial statement. And finally, comparative information should be present in a financial statement. For example, in a balance sheet of 2022, we are required to present the data of 2021 also. We also discussed the difference between current and non-current asset and current and non-current liability. And finally, we discussed about monitoring developments in financial reporting standards. There are several changes that keep on taking place in the financial reporting standards, and we need to make sure that we are on top of every change that is taking place, because as professionals, we need to make sure that we have the information that our clients need so as to conduct a proper financial statement analysis and give correct information to our clients. Thank you so much, everybody. This was today's class. I am Rishi Jain. Thank you, everybody. I hope you loved today's class, and for any feedback and any queries, feel